So this is weekly commentary 40. Now, we've entered that time of year where the market starts to slow down. We're going to see the weekly ranges and the daily ranges start to diminish. And that's purely because of the fact that we're going into that last quarter of the year, right? We're going into the month of December. Now, in the month of December, there is going to be you know, a backing off of smart money entity and large funds players in the market. And the reason is because in America in December there is many holidays, and it's a time where there is no added risk by large institutions. Now by added risk I mean, no one wants to entertain a position at this time of year, given that it's a time for holiday and whatnot. Now what does that relate into? There's a retraction in liquidity, and a retraction in liquidity means that there is less kind of fuel for the algorithm to work off of, because it's delivering orders. Now, if there's a lack of orders, there's not much range that it can deliver. So going into back from last week, we expected a move higher and start to, rebalance this inefficiency, right? Because we had this large move. Now we wanted to see, a move. I wanted to see a move, a bit deeper into this retracement, specifically into this, into this down candle. But nonetheless, we got some, sort of move into this area of imbalance, and then we start to see the candles print lower. Now, this is going to be what the next chapter, the first lesson of the next chapter is going to speak about, the open, high, low, close, right? So we had this candle. Now, the next candle after this would have, gave a lot of intel for the, the willingness of the market to trade higher or lower, because this is exactly what it is. Now, we're knee deep into the mentorship at this point. If you've been attending every single weekly commentary, then you are practically knee deep in terms of studying the markets alongside, how I've taught you to review the markets. Now, what we need to depict from the higher time frame is this, and it's very simple. It boils down to one thing. Does the next candle have a greater willingness to trade higher or to trade lower? Notice how I didn't say close, right? Do we have a greater willingness to trade higher or lower given the past price action? Now, what do I mean by the past price action? This is what I mean, right? We had this displacement to the downside. Now, we had this candle retrace up higher. Now, if we had a three bar formation created with the next candle, this one being bullish and the low being, higher than this candle's low, then we'd have a retracement on our hands and we could expect a retracement higher, right? So we would have anticipated that candle to have a greater willingness to trade higher rather than lower, given the fact that we had a three bar swing low formation. However, what we have now is this, right? We had this level of imbalance from this candle's high to this candle's low. There was a lot of inefficiency within this candle. Now, specifically on the 4 hour, the area I wanted to see retraded to, right, was this specific area. I marked out this area, I believe, on the Telegram, and I'm sure on the weekly commentary I mentioned this area is an area that we want to trade back into, right? You see it's quite gappy, and it's just an odd looking area on the chart. Now we got close to it and we didn't quite get to it, right? Nonetheless, we got close to it. Now from there on the weekly, right, we then displaced lower. So it's clear that there's a retracement on the hands for the DXY. Now, using just the simple idea of where is the next candle likely to trade higher or lower, is there a greater willingness to trade in one way over the other, given the price action, I'm anticipating the next candle to draw lower. And lower until where? Now, we have this weekly fair value gap marked out between this candle's high and this candle's low, and it's also within these two down close candles, specifically this last one being the order block, right? These two do make up the order block, as they're consecutive. However, there's always an emphasis on the absolute last candle, right? This is an area where I want to see price draw towards. Now, if we go into a daily time frame, right, I'm viewing this as somewhat as a potential market maker buy model, with this being the initial consolidation, and this is just going to be the essentially the sell side of the curve. I want to anticipate a possible smart money reversal, around this area, right? Maybe inside of the fair value gap is the best you know, bet where I'd expect it. However, just, under one of these sell side liquidity pools being here or sweeping this level here, right? I want to see the smart money reversal occur here and potentially move up higher. Now, we could consolidate here given the time of year. However, for this week, I'm expecting somewhat of a expansionary move, and the reason being is because if we go to, the Forex calendar, on Tuesday we have the consumer confidence, and then we have a few red folders given on the Wednesday, and then we have the Friday, the normal NFP for the first Friday of the month. Now, given the time of year, I expect this to be, one last expansionary move to the downside, and then possibly for the rest of December we could consolidate, right? Now, that expansionary move lower would bring us closer to this fair value gap, and then for the rest of December, especially the middle of December, I'd just expect a consolidation, and that's what you usually get. And the candles usually get a lot smaller. Now, if we go to Euro, right, we see that we're running up highs. Now, if we go to a weekly chart, right, we're working inside of these up candles, right? Now, there is also a very small fair value gap to give attention to between this candle's high and this candle's low, right? And this being the order block. Now, I want to see us work up towards this area first, right? This area is the one that matches up with the run on the DXY to 103. However, wherever Euro runs, remember we're always using DXY as the gauge for where Euro is running, right? When the DXY runs into this area, that is when we look at where the Euro is and we try to match where the DXY is in terms of the weekly fair value gap with where the Euro is, and also pound is very similar as well, right? Pound has the fair value gap from here to here, and that's something to consider as well. Running, you see these candles, right? Their tops are quite flat. I'd like to see a run on that. And also the US 10 year is showing a great willingness to go down lower and lower where? Well, we have this monthly liquidity void. Now, why is this a liquidity void and not a fair value gap? You see this candle, right? If I just bring this down lower, you see how this candle doesn't wick, right? It doesn't go up and then come down. So there's no wick from here to match the low of this candle. It just opened and it moved again. That's a liquidity void, right? There's only been buying in this candle up until this point. It's a liquidity void, right? I want to see price come and trade underneath this, this monthly low on the US 10 year, and it matches up with the, the seasonal tendencies of the, the DXY. At this time of year, we, see a retracement on the DXY. And why do we see a retracement on the DXY and a lot of on the bonds? It's that time of year where there's a step back from smart money entities, right? And it's usually just an accumulation phase on a higher time frame. Now, to reinforce the idea of an accumulation phase, and the reason why I'm still overall bearish for Euro USD, it's just a higher time frame correction that we've anticipated, right? If we go to the COT data, and I go on currencies and we go on euro dollar. Now, if we go to the COT data, we see that there's been, an increase in the net short position for euro dollar, and now we have retail going long, right? You see the blue line. This is, retail. This is us, right? Speculative money. This is retail institutions, and this is speculative money, which is basically us. When I say us, I mean the retail guys, right? Now you see they are starting to go long, and these guys are also long, and you see that the commercials, the large funds, they're starting to go short. Now, when we see this, right, we understand that this is a pairing of sells, they're pairing a short position with buy side liquidity. And I view this as a market maker sell model. Essentially, they're hedging a short position with the move higher. Now, if you can see this as some level of initial consolidation, and this is an expansionary move, right? I'm awaiting for a smart money reversal that's in line with the COT data and preferably that's in line with this DXY fair value gap on the weekly, right? It's all in line with the COT data and it's essentially what I'm anticipating. It's just you have to respect, where the order flow is pointing towards. Now, we have this sell side liquidity pool to work for towards this week, right? We have this volume imbalance that we had, and we still have this candle to work in towards to rebalance this level of inefficiency. And we have these three up candles being one order block, this candle being a mitigation block. However, watch the run into the premium of this range, right? From this high, to this candle's low right now. I want to see at least the open of this candle get hit and then monitor it from there. Now, remember what week we are going into. It is NFP week. I have to give the same warning every single month, unfortunately, to you guys because, I understand that there is a tendency to try and, get in a swing on NFP. Now, there's times in the market where there's a greater reward for sitting out in terms, and then compare that to actually participating in the market. And the reason is this, right? There are just some conditions in the market which are just not favorable and which is just not meant for us to trade. And I say it all the time, a consolidation is not what we trade in. A consolidation is what we hunt and where we sit on our hands and we await the expansionary move after that, right? Now, on NFP, the day before is likely, especially from after London, the New York session is likely to go into, and the CBD on the Asia is likely to range, how we want it. London can offer a small scalp. New York, you don't want to trade it at all, right? NFP is one of those days where you let the market makers have their way. You don't want to sit there and entertain it because let's say for whatever reason you do win, and this is actually something that happened to me, you know, a few years ago, right? 2 years ago when I was a retail trader, sometimes I would always trade NFP and sometimes I'd win, more times I'd lose. But the idea of me that I knew that I won once and I won big, that kept me coming, right? It was a gambler's mindset essentially that kept me coming because I knew that I have a chance at winning, right? Essentially, I had this a 50-50 go higher or go lower. But it's not a 50-50 because it will wick both ways and it has a greater chance of taking you out than keeping you in the trade, given that you have a stop loss, right? Now, some of you may have had that same experience where you caught a large move from a news driver and, that just always rings on your head that I could catch this again. But that is the gambler speaking, and you need to let the trader take the wheel, right? Let NFP pass, and I say this: the NFP is usually, an expansionary move. That move is likely to give us some level of direction for the higher time frame. Now, giving up 1 or 2 days for a week's worth of bias the next week is a fair trade-off, in my opinion, right? From here, although we can consolidate, there for me personally, from the lens that I view it and from the entire narrative of the DXY, I have a greater willingness from my understanding that the candles have a greater willingness, my bad, should trade lower rather than higher, given the open high low close that we swept this bullish candle's high and now we're working towards the low of the candle, right? We took buy side liquidity and we rebalanced the level of inefficiency. So I expect the next candles to print lower. And that's for all time frames. However, the weekly candles, this depicts the weekly bias, right? Now, in saying that, the move to here, I don't expect it to be quick. We could just be quite jagged in the way that we get there. Given the time of year, remember, it's that December, that festive celebration period. We don't expect large moves here. And you can see it within the weekly candles. If you compare these two weekly candles to, the last five, for example, right? One, two, three, four, five, right? they are smaller in the average size of these candles. The next week's candle, right, and especially the middle one, the week of Christmas itself, you will see that it is going to be a very small range. Don't entertain the market. Rather do this, and I'm going to give you guys somewhat of a homework for the people that are caught up. Attend every single session and do this. Have a read on price and your high time frame PD array matrix and your arrays marked out and your daily and your weekly highs. And as price trades and displaces away from specific levels, say to yourself, I think that the next start on the 1 hour, right? Because the 1 hour is a good, you know, middle ground between a fast and a slow move, right? Go on the 1 hour chart within the kill zone for the London or the New York session, or both if you trade and attend both, and say that from this area, I think that the next candle should print higher or lower as there is a greater willingness to trade in this direction given what the current price action should have done. And get good at doing this on a 1 hour, and this is how I practiced. Right, I done it on the 4 hour and then I done it on the 1 hour. And the 1 hour is the gateway to get into being able to do the open high low close for the 15 and the 5 minute chart. Don't worry about the 1 minute chart, how I do it in the Telegram group chat for now. Go into the session with that 1 hour open high low close mindset and start to try and get a gauge for when you can expect a open high low close candle or an open low high close candle, essentially a bearish or a bullish candle, given the context. And something like this can help you do it, right? You had a bullish candle, we're offering displacement to the downside, sweep on this candle's high and move lower. You can expect the next candle to open, trade a bit higher, right? Maybe into this candle's body somewhere, and then trade lower into an area like a high time frame, an opposing array. For example, here we have a weekly fair value gap. That's how you use open high low close. It's just very intense when doing it on a low time frame. Hence why I've told you find the middle ground in the 1 hour, right? Now, for the stock market, the US 500, watch the move into this volume imbalance, right? You see this candle's high, mark that candle's higher as a buy side liquidity pool, and you can try and frame the move into the we kind of got above this candle's high, towards the end of the week. It was quite a shadow run. I'd rather see a more powerful punch above it, right? But even with the S&P, this is the time of year you want to avoid the S&P. The same reason for the DXY is that festive period, there's a retraction in liquidity in the market, especially the stock market. There is no added risk at the stock market at these time of years. From an institutional standpoint, actually, what institutions do within this quarter, they actually plan for the next year, strategies and whatnot. If you study finance in the UK, a degree in finance or finance modules, you'll understand and see that this is common knowledge that is probably taught in all colleges and universities. Institutions take specific times to plan accordingly and a new strategy and reflection and whatnot. And this is usually the time of year to do it. They don't engage in any added risk, and that retraction in engaging in any added risk leads to the lessening of the range on the daily, weekly within this December to January. Even till the middle of January, it is pretty dead in the market. Now, the weekly commentaries is going to be a lot of what ICT calls jawboning from me because you know there is a level of uncertainty. Now, the DXY here, I have a great tendency to say this one's going to trade lower. If we go back and forth, there is no there's no reason for me to say there's a greater willingness to trade higher or lower for you guys because in a consolidation, it's just building sentiment, and you don't want to add your sentiment, right? Let them build the sentiment of retail, not the sentiment of you as, the more informed trader, right? Now, I'll rather see this candle's low get run after running this candle's high. Now, if we run this candle's low and we come back into the range and we consolidate, that is a seek and destroy, and you'd want to avoid it, right? To conclude the weekly commentary, I'm expecting the next candle for the DXY to trade lower, and I want to see this weekly fair value gap start getting traded towards. And on the DX, on the Euro USD, we just want to pair the run into, above these areas. Whenever the DXY gets here, look to your chart for Euro USD. I'm assuming that it's going to be traded into this area just from, my experience in pairing the runs with euro and dollar and with pound. uh, Watch that run into this fair value gap. Mark that fair value gap out. Mark this as the buy side liquidity pause. And if you do want to entertain anything on a paper account, which I recommend everyone, the ones that are funded, because there's many of you now, switch to a paper account. And just the last message for the funded guys: make your first payout and get break even on that challenge. See the challenge initially as an investment. You paid for it, and now after the first month for my Forex runs, you get an 112% refund. So you get profit on top of the refund, as well as your first payout and a bonus for phase one and phase two, I believe. So make sure that you are submitting to a mellow risk management plan. You are accepting a small percentage gain a month, and if you do want to make more money, go with the mindset to get more capital, right? Because there's two ways to increase your take home profit. Is either increase your capital size and apply the same expected monthly return in a percentage form, or try and make more percentage on the same capital. Now, the safer way to do it is increase the capital and apply the same risk to the account. Because applying more risk can also is a double-edged sword, right? You can also lose, the potential gain that you're trying to make. So rather get more capital and keep the same risk. So that's really it for this weekly commentary. Um, any questions, of course, ask. For the next lesson, I've been a bit busy. Even today, I have to, I have to visit some family. Um, the lesson for chapter 6 is going to be done sometime this week, and then the following lesson should be done throughout the month of December, and it will conclude, for final contents for the mentorship. These are essentially you can call it the bonus videos for the mentorship, right? So until next time, and I'll see you guys in the next one.